risk assessment procedures. Without referring to your notes, without referring anywhere apart from your memory, just refer to your memory. Refer to your memory. Inquiries. So, candidates, risk assessment is a critical process where the auditor identifies and evaluates the potential risks of material misstatement in an organization's financial statements. And the risk assessment forms the foundation for designing and implementing effective audit procedures. Audit procedures, the ones that you are now mentioning, substantive, test of control. Do you understand? The auditor, before deciding the extent of substantive procedures, before determining the extent of tests of control, the auditor has initially carried out what we are calling risk assessment procedures. Inquiry, that is a procedure. Inquiry. To inquire is to ask, asking questions, engaging in discussions with the management, engaging in discussions with those charged with governance, engaging in discussions with the internal auditors and other relevant personnel within the company. Engaging. Because then that allows auditors to gain insights into the company's operations, industry trends, potential fraud risks, changes in internal controls. The auditors will also get to know the management's perspective on risks and how they are being addressed. So inquiring, having a discussion with the management in relation to risk, asking the management, what do you think are the potential risk areas of material, say, misstatements in the financial statements? You ask questions, ask the auditors, internal auditors, talk to those charged with governance, talk to for example, the board of directors and so on. Someone says communication with predecessor auditor. Let us exhaust this point on inquiry. Inquiry. Right? Inquiry. That is a procedure. And mainly candidates, almost all procedures, when you ask to identify procedures, audit procedures, inquiry at least, please don't forget to just say inquiry. Because the auditor can only gather evidence from management. If it's to carry out audit procedures, the purpose for carrying out audit procedures is to gather evidence. This evidence is about financial statements which are prepared by the management. So the management may have, or not may, but the management or the company has more information than the auditor. So if he wants information or evidence, one way is to ask those charged with governance. So here we are talking about risk assessment procedures. How are these procedures conducted? How are the procedures, analytical procedure, conducted? Analytical procedures. Now, analytical procedures involve candidates. You've done financial statements analysis, right? Financial statements analysis. Analytical procedures involves evaluating financial information through analysis of the plausible relationships among both financial and non-financial data. And as Joseph says, by comparing current and prior period data, comparing industry benchmarks. And Joseph, it is not just prior financial statements, it could also be comparing budgeted amounts. All that is involved in analytical procedures by comparing current statements that the auditor is to audit with prior or previous data, or comparing current and industry benchmarks, or comparing current data with budgeted amounts. Auditors can identify unusual fluctuations, inconsistencies, or trends that might indicate errors or frauds. Because candidates, we are discussing risk assessment. So by doing that, by comparing financial data, current with the benchmark, current with the budgeted data, current with industry benchmarks, the auditor can identify inconsistencies or even unusual fluctuations. You understand? Analytical procedures is a procedure that can be used in assessing risk. You understand? Inspection. Correct. Inspection is a procedure. Number 3, inspection. Let me add it. Let me add observation. So this could be considered independent procedures. We have inspection and observation. Inspection and observation. Inspection and observation. This involves physically observing the entities, processes, or activities. Inspection involves inspecting documents. You inspect documents, but you observe activities and processes. You inspect documents. You inspect records and tangible assets. Like observing if they are what do we call them? Say inventory. The auditor can observe inventory taking. Okay, that is one way to assess risk. The auditor may also do what? May observe cash handling procedures, which can reveal weaknesses in internal controls. The auditor can inspect documents like invoices, contracts, which can uncover discrepancies or even unauthorized transactions. and such observations can provide real world evidence of potential risks. If you observe how maybe cash is being handled, how cash is transported maybe from the business to the bank or from the bank to the business, look at the procedures. You can know if there is risks associated with such processes. So that is a procedure: inspection, observation. You understand? That is the second or the third procedure. We have to give 3, but we can do 5. Can do 5. Give me the 4th. Risk assessment procedure. Risk assessment procedure. Inquiry, analytical procedures, inspection and observation. What do you think? Another way is through prior period. Let me say prior period information. Prior, what do I mean? When I say prior period, if your auditor is auditing 2024 financial statements, the auditor can check the previous prior period information. Reviewing the results of the prior period audits. Results of prior period audits. Results of prior period audits, including identified misstatements. Prior period. Identified control deficiencies in the prior period. Okay? You understand? And even areas of emphasis. Prior period information candidates can provide a valuable insight into recurring risks, into the effectiveness of management responses to past issues. If in the past there was control weaknesses in the internal control system, and the prior auditors made recommendations on what ought to be done, the auditor can evaluate such information and find out if the management took heed of the recommendations and acted on the recommendations. You understand? So this is reviewing prior period information. And candidates here, the auditor has not begun the audit work. Is just assessing the risk of material misstatement in the financial statements. So that if in the prior period the management was advised by the auditor to make certain corrections, for instance in the internal control system, and that was not done, then that means that there could be still risk in such areas. So that is a procedure. Review the results of prior period audits. These are not just financial statements, but audits, prior audits, including identified misstatements, including deficiencies or weaknesses in the internal controls. You understand? Let me stop at number 5, which is review of external information. Review of external information. Review of external information. review of external information. What do I mean by review of external? Here, candidates, the auditor examines information from sources outside the entity, such as industry reports, information from regulatory institutions, or from information on, say, the economic environment, or even competitor actions that can introduce new risks or even increase existing risks. Exacerbate, that's the word, exacerbate, to exacerbate the current risks. External information, reviewing external information. This is information outside the organization. Most industries have reports. If it is banking, you'll have reports on banking. If it's insurance, there are reports on insurance. You may have reports from the capital market authorities, reports on the securities exchanges, reports on any other regulatory bodies, because there is such thing as regulatory risks, candidates. You understand? Such information can only be obtained by reviewing information from external sources, and that includes information on competitors. If a competitor has maybe a top-notch technology, or has state-of-the-art machine or equipment in production, and you are competing with such a competitor, there could be a risk. It can drive you out of the market. So the auditor has to also evaluate such information, including information from actions of the competitors. You understand? And that can be done by reviewing prior results, reviewing the results of prior period audits. Because the prior audits may also have some information in relation to these matters that we are talking about. That can also be done, candidates, by that can help the auditors understand the broader context in which the entity operates, the changes in industry landscape, the economic conditions, and so on. The auditor can check regulatory publications, news on the economy, and so on. So these are 5 risk assessment procedures. The question was not just open on any procedures, candidates. All right? Do you understand? It was specifically in relation to risk assessment procedures. So what can the auditor do to assess risk?